Before we talk about adjusting entries, let's briefly review the three basic steps in the recording process. Step 1 is we analyze each transaction for its effects on the accounts. Step 2, we enter the transaction information in a journal. And then finally, or step 3, we transfer the journal information to the appropriate accounts in the ledger. The steps in the recording process occur repeatedly. So during the period, the accounting system records daily transactions, which typically involve cash. This presents a problem. Cash is not always received in the period that the company earns revenue, and cash is not always paid in the period in which the expense is incurred. The solution is adjusting entries. Companies make adjusting entries at the end of the accounting period. These entries ensure that the companies record revenues in the period in which services are performed and recognize expenses in the period in which they are incurred. Adjusting entries ensure that both the revenue and expense recognition principles are followed. Remember, the steps in the recording process happen during the month, whereas adjusting entries happen at the end of the period. The first step is we prepare a trial balance. Each account is analyzed to determine if it is complete and up to date for financial statement purposes. The second step is we will adjust revenue and expenses and the related balance sheet accounts. And then finally, or step 3, at that point, we can prepare financial statements. Adjusting entries are required every time a company prepares financial statements. They will include one income statement account and one balance sheet account. Do not use cash. The types of adjusting entries are prepaid expenses, unearned revenues, accrued revenues, and accrued expenses. To defer means to postpone or delay. Deferrals are expenses or revenues that are recognized at a date later than the point when cash was originally exchanged. Two types of deferrals are prepaid expenses and unearned revenues. Prepaid expenses are expenses paid in cash before they are used or consumed, whereas unearned revenues, the cash is received before services are performed. The second category of adjusting entries is accruals. Prior to an accrual adjustment, revenue and expense accounts, as well as their related balance sheet accounts, are understated. As a result, the adjusting entry for accruals will increase both a balance sheet and an income statement account. Revenues for services performed but not yet received in cash or recorded are called accrued revenues. Expenses incurred but not yet paid in cash or recorded are called accrued expenses. The pattern that results when recording an adjusting entry for revenue is debit a balance sheet account, such as accounts receivable or unearned service revenue, and credit a revenue account, such as service revenue. The pattern that results when recording an adjusting entry for an expense is to debit the expense, such as insurance, supplies, interest, or salary and wages expense, and credit a balance sheet account, such as interest payable, salary and wages payable, or possibly an asset, such as supplies or prepaid expenses. Be sure to note that each adjusting entry affects one balance sheet account and one income statement account. We'll take a look at some examples in the next video.